Hi everyone, I hope this video finds you well. This is the recorded lecture for Chapter 18, Integrated Audits of Public Companies is our topic. This is essentially when we have a financial statement audit and we're also given an opinion on the internal controls. So let's go ahead and work through this. There are 6 learning objectives here. Notice that they're all medium and high priority because this is a pretty important topic. This is going to be, this is, we'll kind of see how this kind of came about ultimately from the Sarbanes-Oxley Act. But we'll kind of work our way through understanding what the integrated audit is, thinking about the manager's responsibility, then thinking about the auditor's responsibility, and then thinking about how to analyze internal control, and then deal with the findings and potential modifications to the report. So the first learning objective is just understanding the nature of it. And so ultimately, if you're a publicly traded company, that you're under the SEC, and audits have to be done by registered auditors under the PCAOB. That means you have to have an audit, and your opinion has to cover a financial statement audit, and you also have to have an opinion on the internal controls over financial reporting, basically over the process of creating the financial statements. The standard number 5, AS5, is where this comes in. So Sarbanes-Oxley, section 404, that's essentially where the internal control has to be included. And so the first section of 404 is essentially the management responsibility. They have to establish and maintain it. They're actually going to do an assessment as well, which we'll talk about in a minute. And then section 404B is that the CPA firm has to actually audit the internal control and express an opinion on the effectiveness of internal control over financial reporting. It's not in that little paragraph, but it has to be over the financial reporting. And so large companies with capitalizations over 75 million are required to do that under SOX. So let's think about now what's management's responsibility. And so they're accepting responsibility to make sure that the internal control over financial reporting is effective. They're going to evaluate the effectiveness of it using a criteria. We'll talk about the criteria in a minute. And then they need to basically collect evidence, right? Just like auditors have to collect evidence about how effective controls are, managers have to collect evidence and provide a report ultimately on internal control that will be included in the financial statements. And so what does this report have to cover? First, just acknowledging it's their responsibility to establish internal control, and then what's the framework they use for evaluating internal control. Almost all publicly traded firms use COSO, the COSO framework of internal control, which we've talked about before. And then it has to include ultimately their assessment, okay, in terms of how effective they think the internal control over financial reporting is. And obviously the auditors for publicly traded companies are going to assess that as well. So here's an example of a management report. This is from Lowe's, one of our local large corporations, right? Again, they're acknowledging in the first part here that it's their responsibility, and it's designed to provide reasonable assurance. Right, so again, it's their responsibility, and it's designed to provide reasonable assurance in terms of the reliability of financial reporting, right? They're acknowledging that every internal control system has its limitations, and that's why we can only get to reasonable assurance, okay? And then they're basically saying who is responsible for this. The CEO and the CFO are going to evaluate the control as of a certain date prior to the issuance of the financial statements. Here's their criteria, right? They're using COSO. That's the long name for COSO. It's their framework from 2013. And then they're saying based on their assessment, we think our internal control is effective, right? So then it just basically tells you that their auditors that audit the financial statements were also engaged to audit internal control. And that, and that's a pretty standard statement on internal controls from a company, covering those aspects that are required for their report about internal controls. Now, how they do the assessment, you can have consultants help. The firm can have consultants help them, but it can't be by the auditor that conducts the audit, because we've talked about independence before, right? And you can't, if you're going to be a part of the assessment as the auditor, how can you also assess that assessment? Because that's part of what the auditors have to do. They have to evaluate what did the management do, and then decide whether that was a good assessment or not. They can't give an unbiased opinion if they're part of that process. So it has to be someone else if you're going to use outside entities. Obviously, there has to be an internal control definition. You have to agree with that the SEC considers, and you have to use an accepted control framework. COSO is the only one I've seen. It's possible there's others, but that's the only one I've ever seen in these internal control reports. And then we'll talk about these three levels. These are the three possible levels of control issues. And so we'll need to go through those here in a few minutes. Okay, so we've gone through the five components of internal control before, so I'm not going to spend extra time on that. That's the same five components of the COSO cube we've referred to in the past. Here's something new, though. When we find some problems, right? How does managers assess that? How do the auditors assess it? And so ultimately, what we're looking for are problems related to preventing or detecting misstatements, right? Because that's, we're talking about internal controls over financial reporting, ICFR, sometimes how it's referred to. Then ultimately we care about being able to prevent and detect misstatements in the financial reporting, right? That's the kind of the end goal. And so ultimately, when there's something in a control that basically doesn't allow the firm to do that, then that's when we identify a control deficiency. So we have a couple of levels here. It's almost easier to start with the highest level. It's material weakness. It's a reasonable possibility that a material misstatement will not be prevented or detected, right? So that reasonable possibility. Significant deficiency is less severe than that, yet still important enough to be highlighted. And then kind of everything else falls into this third bucket of less than a significant deficiency. Okay, so if it sounds kind of squishy, it's because it is, right? We got this reasonable possibility. There's not a threshold number there, right? That's reasonable. And then we get something that's less severe, but still important enough to merit attention. So there's a lot of judgment in internal control assessments. Okay, so do we need to modify the management's assessment of internal controls based on the three levels? So again, let's start with the highest one. We got a material weakness. Again, there's a reasonable possibility there is a material misstatement that was not prevented or detected. Then, yeah, we need to go ahead and we're going to modify that assessment. So that clean assessment you saw from Lowe's would not be stated that way if there was a material weakness. That would have to be disclosed. What about a significant deficiency? So it's less severe than a material weakness, still important enough. And that one does not need to be disclosed in the management assessment or the audit report. Because remember, this stuff goes to the public, right? And so ultimately there's a materiality threshold around what we disclose to the public. And so we're only going to disclose if there's a reasonable possibility of a material misstatement that was not prevented or detected. If it's less than that, then it will not go public, but we'll talk about in a minute where it goes. And then the less than a significant efficiency, we'll refer to that too in just a few minutes. So, what's the objective here of their evaluation of internal control as a manager? Well, they're trying to provide evidence, or collect evidence rather, for its assessment. So they're going to do a similar process. They're evaluating the design of controls, and they're evaluating the operating effectiveness of internal controls, right? And then management is responsible for documenting the process, and then obviously they're going to issue their assessment with the financial statements. Okay, so similar, at least parts of this is similar to what the auditor's going to have to do here when we see in just a minute. But evaluating first, are these controls, even if they work perfectly, so let's say they work 100% effective, are these good controls? That's what that first one says, right? And then operating effectiveness says, well, are we really at 100% in terms of operating effectiveness, in terms of how often this is done, and is it actually catching the problems it's supposed to catch, right? So the first one says, if we assume they're operating perfectly as they're designed, is that effective? And the second one says, now we're going to actually question whether they are operating effectively based on how they're designed. Okay, so I'll pick up with another video with the next learning objective.